Thank you so much. I want to thank everyone. It's kind of been a marathon couple of days, and I know it's tiring, but we have an awesome panel. And emerging markets, in the end, I think is the barometer for how the global economy and how financial market stresses are doing. If I had to summarize sentiment at these meetings, it's really quite bearish, right? There are all kinds of risks on the horizon. Every discussion, every meeting that I have done starts with what is your estimate for recession risk? And most people are incredibly focused on that. And I have sympathy for it because I think from an investment point of view, right, whether or not there's a recession, you basically have to completely rejigger your portfolio. If there is a recession, then 10-year treasury yields at 1.75 or whatever they are now, maybe they're not that low, right? Maybe they can go a lot lower. Versus if you don't believe in a recession, then we could have a meaningful risk bounce on a trade truce and okay-ish data. And so I think from the perspective of investors, from the perspective of risk appetite, in the end, emerging markets are the barometer. I have an incredible panel of practitioners and people who look at emerging markets very closely, and so I want to thank all of them. And I just want to get into it with a question on where we are and how did we get here. I personally got here this morning on the subway. The question that I want to ask basically is emerging markets have been a very difficult space for the last 2 years, right? And for someone who is a value investor, for someone who's looking for opportunities to invest, at many points in time, emerging markets have looked compelling and cheap. But it's actually been a very, very difficult trade because things that have looked cheap previously ended up getting cheaper. And so I just want to start by asking the panel, why is that? Why have the last 2 years been so difficult? Is it about geopolitical risk? Is it about the US president? Is it about data? Is it about positioning? So maybe Tanya, can I call on you maybe to kick us off with that topic?
Sure. Glad to be here. Thanks for the invitation. Before I start, just to keep my compliance department happy, I have to clarify that these views are my own and not of Alphadyne. I think that that question to me is just centered on the combination of global growth slowdown. We have seen that trade uncertainty has affected export numbers in all of emerging markets, most notably in Asia, but everywhere else. You have seen that in commodity prices, which are key for certain emerging markets, certainly, for example, in Latin America. You have seen the consequences of that on investment uncertainty and capex numbers falling abruptly in many of these places. So despite the fact that we have seen a turn of global central banks to be more accommodative in their monetary policy, they have to fight the a wall of uncertainty, investment slowdown in the rest of the world, and that has kept emerging markets in a very tough situation on top of the political risk. Yeah.
Gorky, what do you read into the past 2 years?
Tanya is absolutely right in describing the context, right, that we've been operating in for the last couple of years. But I think there's a couple of distinctions that are necessary to be made here. 2019 has actually been a pretty good year for emerging markets from a performance perspective, right? I mean, spreads have come in sovereigns by about 80 basis points. Of course, the big move in US rates has propelled total returns to low double-digit numbers. I don't think anybody expected at the beginning of the year that we would be sitting here in October with total returns of 13%. Local markets, that's been the more challenging component, right, within EMD. EMFX is actually still down for the year if we look at the basket. If you look at emerging equities, you're going to see a lot of correlation between the two. They tend to feed off each other for flows, positioning, etc. But local rates, which is the other big component of local markets, actually is also doing pretty well. Yields have come in about 120 basis points. So this is a little different than 2018, right? In 2018, we had beginning of a global growth slowdown, and the U.S. decoupling in a big way, pushing rates higher, triggering a revaluation of the USD. The combination of that is pretty complicated for emerging markets. So even though we've had a number of idiosyncratic stories within the asset class, right? Argentina, Turkey to some degree, Ecuador more recently. The notion that this is an asset class that has not compensated, especially on the credit hard currency side, is not correct. So investors that have had exposure in a horizon over a cycle have actually been pretty well compensated, including, of course, years where we've had significant drawdowns. It actually is a fairly mean reverting asset class. So to the extent that you're getting paid in excess of what you get paid in developed market credits, be it in investment grade or below investment grade, emerging markets actually do perform. So it's a matter of trying to avoid some of these air pockets that come here and there. But the notion that it's been a bad year, I think I disagree with that.
Yeah,
maybe just quickly follow up on that, and particularly the comment that emerging market FX has not really been doing so well this year, despite it being a better year.
Last 5 years, actually.
Overall for the asset class. I think there's a couple of things that might be worth mentioning here. One is sort of how the trade war and all this stuff has panned out in terms of the dollar.
Yep.
The dollar in some ways has behaved exactly as the textbook would tell you. When you raise tariffs, your currency is going to go up. So that's one element. The other element is, when we see more tariffs coming from the US, the pattern tends to be what we do is we then downgrade our Chinese growth forecasts, and then we think about, well, how does that spill out across the rest of the world?
Right.
Well, it actually spills out across the rest of the world in a way that's less damaging for the US economy than it is for other economies, particularly the Eurozone. So from a sort of G3 exchange rate perspective, it's a dollar positive move. So I think that's been one of the sort of global macro kind of context in which this EMFX underperformance this year has maybe has to be seen.
Right.
The other is just the speed with which central banks around the world, including in emerging markets, have also pivoted after the Fed pivot has been absolutely staggering. So we look at this in terms of what we call it. It's sort of an index of the breadth of monetary policy direction across the world. So how many central banks out of a sample of 50, which share of those are tightening and which share of those are loosening, and we track how that moves over time. And the swing that we've seen since December 18, January 2019, from everybody tightening through 2018, nearly, or not everybody, but a very high majority, to now nearly everybody loosening. The speed with which that turnaround has happened is unprecedented since 2000.
Yeah, remarkable.
There's been absolutely no relative loosening of US monetary policy at all. So I think this feeds into the rates point, I think, doesn't it? It's just like there's been a very, very quick monetary response in emerging markets.
But inflation
is
allowing that, right? Very low. We're going to be at historically low inflation numbers this year, ever, in emerging markets.
I feel like I'm losing control of this panel.
But because I think this is a very key point, and the different performance of the different asset classes, because we have performed fantastically, spectacularly well in EM rates, because global rates have been coming down. Inflation in EM has been coming down, and key to this, pass-through is dead. FX pass-through is pretty much dead. So we have seen FX depreciate, or in some cases quite aggressively, and the pass-through to inflation is minimal. So that has allowed central banks to continue to cut rates, and my guess is that they will continue to do so. And more, these central banks are letting their FX go, because why not? The FX adjustment allows them to use the FX as a shock absorber to all the trade wars, so it's in their benefit, and they are not paying the cost of inflation. And in most cases where they can do this is because the profile of their debt is local currency denominated, so they have no problem allowing the FX to go. So in that sense, my view is FX in EM has underperformed, and I believe it will continue to underperform because in EM right now you have no carry and no growth, except in very few cases there has carry, and they have carry for a reason. But in the broad EM, where the carry is quickly disappearing and we have no carry, we have no growth, there's no reason to be there without hedging the effects pretty much. So I think it's going to continue to underperform. So actually talking about EM as an asset class doing well or bad is probably the wrong way to go, and you do have to distinguish whether it's debt, rates, effects.
Can I pick up on the relative
Yes.
monetary policy
Yes.
comment that we made, right? Which is that the U.S., let's not forget that the U.S. until last month was reducing the size of its balance sheet through this
Right.
entire period, right? So what's remarkable about 2018 and 2019 is you had the Fed reducing its balance sheet that entire period. You had the Fed raising rates in 2018 until the market taught them they were making a policy mistake. Then they've been cutting rates since then, but in a way that hasn't really created any relative monetary policy easing to the points that you made. Now the fact that they've stopped QT and their balance sheet is increasing, and they're going to great pains to tell you it's not QE, but it's not QT. I can tell you that much. I think a balance sheet increase is a balance sheet increase is a balance sheet increase. I think this is a key time where we could start to see U.S. monetary policy on a relative basis kind of get a little bit easier. So that would give us a much more positive environment for EM. And all these points that we made, economic uncertainty, so policymaker uncertainty, I think however you measure it, is very high. Trade uncertainty, very high.
Right.
Economic growth in EM, very weak. I mean, this week, the IMF revised down EM growth by 0.5 percentage point.
Yep.
How much of that is priced in was what I would ask. And I'd say a lot of that is actually probably priced in now. Just the fact that the IMF revised down their forecast by 0.5 percentage point tells us a lot more is priced in. So if you have some of those bad things priced in and you can get a relative turn, then you can get the dollar to come off.
Yep.
To me, that's a very favorable environment for local.
Yep. Can I, moving from the discussion of how we got here to now, and Rob, you're basically going in this direction already, so the forward-looking, the prospects now, I have, my own behavior has certainly been influenced by how EM has traded. I remember going on vacation in August 2015 when the RMB had that huge step devaluation. It ruined my vacation. August 2018 was the same thing. We had this Turkey blow up that was incredibly violent, ruined my vacation. I've stopped taking vacations in August and now systematically do my summer vacation
Argentina
in July.
this August.
Yes, exactly. Yeah. I didn't do an August vacation this year. I was in the office. So I've become, I guess what I'm saying is I'm scarred by price action, right? And it's messing with my summer. Okay. So if we now think about prospectively, if I had to kind of distill the node around which EM investors are trying to figure out, should I be constructive or should I be bearish? It's basically, on the one hand, global growth may not be great, right? And you have U.S. recession risk, which people are focused on. So U.S. recession, that's never great. For risk appetite, it's probably not going to be great for EM. We have this trade war thing where, as Brian said, right, so U.S. tariffs are dollar bullish, basically. It's not great for EM. So those are the negatives that I can think of. But then offsetting that, you've got central bank easing everywhere, and you've got a Fed that's dovish, is probably going to ease more. So how should we think about trading off these things net? Or should we be constructive? Rob, you want to continue the conversation that you started?
You talked about the U.S. recession.
Yeah.
I think if we're going to be constructive, we've got to take that off the table, right? We've got to say, because in the U.S. recession, that's clearly not going to be good for any global risky asset class. Our view, we've been in this period of declining U.S. growth ever since the fiscal boost in the beginning of 2018. And then we're really moving back down towards a sort of potential rate of growth. And we see very little evidence that there should be a recession. I mean, there's been a lot of talk about the weakness in manufacturing feeding through into services, but as much evidence as we can find of that, we can find of bottoming in German industrial production or various potential places where we might be getting a bottoming. So, we're less concerned about a recession. We just don't see the imbalances that could lead to a recession. So, while that's an interesting thought, we've kind of taken that off the table. And again, so if we take that off the table, then you probably can surmise that a lot of the bad news has been priced into growth. We've revised down growth estimates across a lot of areas recently, and so again, it comes back to what's priced in. And if you get a pivot in a much more aggressive pivot in monetary policy, and you got a lot of bad news priced in, that should be relatively positive.
So basically, a lot is priced, a lot of negativity is priced, and you're not bearish on U.S. growth.
Yeah.
Yep. Brian, can I draw you out on that trade-off and how we should think about EM?
We have a similar view on the US, to be honest, and it's interesting you mentioned the imbalances. I mean, that's the chart we've been showing everyone when they've said, well, the yield curve's inverted, there's going to be a recession, right? And I say no. Look, every recession in the US that we've seen post-war has been preceded by either the corporate sector or the household sector running up a large financial deficit. And we just haven't, although this recovery has been very long, we just don't have those. We don't have those big imbalances. Corporate investment has been more or less covered by savings. Households a big surplus. So we don't see the recession scenario. The traded sector is just not that big in the US. So although the manufacturing PMI is awful, it just doesn't matter as much for the US as it does elsewhere. So on that view, we actually don't think the Fed's got much further to go on rate cuts. But nevertheless, we're miles away on US rates from where we thought we were going to be at this point a year ago, and we're also miles away from where we thought we were going to be on the balance sheet, as already mentioned. So I think, when we look at the drivers of capital flows and some of the sort of modelling that we've done, IF has done, is the lead on this one. But yeah, we find exactly the same thing. The Fed funds rate is a crucial driver, and if we plug that into our models, we actually get quite a strong outlook for
quite a big
capital flows,
push factor.
Big push factor to capital flows to emerging markets over the next 12 months or so. So you really do need a massive surge in risk aversion to offset that, I think, which you would get if you got a US recession. But if you don't believe that's going to happen, I think the global conditions in terms of capital flows are looking quite solid in the near term.
Tanya, can I draw you out on that as well? And in particular, I mean, I have again and again gotten the question. I just don't understand why things are the way they are, and I worry personally that we've done all these monetary policy experiments in the advanced countries, right? I mean, we only ever got the Fed funds back to 2.4%, and now we're back to 1.9%. We have balance sheet expansion of some form, right? Whether it's QE or whatever, we can debate. But over the last decade, we've done all this playing around with monetary policy, and in the end, it was aimed at getting people to take risk, to go into risk assets. EM is a risk asset. As someone who's trading actively, what does the market feel like? Is there a hangover in EM from all of that, or is that kind of a side issue?
Yeah, so I'm definitely a lot more worried. I think that we are beginning to see the limits of that way of thinking about policy and support of risky assets. Of course, the argument we hear here and we know is that the U.S. still has space. We have negative rates in 2/3 of the world. The limit of that is pretty apparent right now. I mean, we have seen the last few days in the IMF meetings talks about reversal rate. I mean, have you reached the end of this? Should we go to fiscal policy? People are beginning to be concerned. But the idea that because the U.S. still has space and it's going to loosen, and this has worked in the past, and if you backtest this, that is true, it's going to support all of emerging markets. And since everybody's bearish because, as we heard, growth forecasts have been revised lower, then all this bearishness is priced in emerging markets, and now with Fed loosening, we should be in Goldilocks again. But the way I see it is different. Yes, we have had our growth forecast revised lower. I think we understand that there's all these risks to growth and trade and so on in EM. That's definitely not a mystery here. But the thing is, because of all these negative rates and because of all this easing, the flows and positioning to EM have continued to be strong. The idea that EM is not positioned is not correct in my view. I mean, we can talk about EMFX, which has underperformed and so on. But for the rest of it, you have to follow positioning and flow data, which is notoriously hard to look at. I like to look at a few sources for this. One is a startup tech app that tries to web crawl the investment universe for positioning and flow. It's called TransFlow. I was looking at this, and this year has actually had pretty good flows into emerging markets. This year has been notoriously better than last year, not as good as 2017, but still pretty strong. The only month where it had negative flow was August. So definitely good.
There you go.
Good call there, not taking vacations in August. But other than that, actually, the flows have been quite strong. So outside perhaps people hedging their FX risk, EM is pretty positioned, and they are positioned because people are looking for carry. They're looking for where to put their savings when you have most of the world at negative rates. So the acknowledgement that the growth, there's now the key word in these meetings is the global synchronized slowdown. That's out there, but I'm not clear that it's in the positions and it's in the price. And if you have a non-linearity in risk, which I think we have seen before, and some of the risks that we all know can materialize on the political side, but also on the growth side, then we could get a more damning environment for trading EM assets. Most certainly on the FX front, and a lot of the currency pegs are at a risk here as well.
Gorky, when I was an FX strategist still in my previous days, when a trade did not perform the way I had forecast that it would, my go-to explanation was positioning. What is positioning in EM? To Tanya's points just now, do you think that there is an overhang from all this QE legacy?
I don't think so. Actually, I think that's a bit of a misinterpretation, and the data, as Tanya pointed out, is tough to gauge, right? And you guys at the IF have done a lot of good work on this measurement of flows. But if you look at the last 5 years, beginning in 2014 up through now, inflows into emerging markets are around 220 billion. That includes equity and EMD.
Yeah.
The equity flows are actually negative in the last 5.5 years, including this year. There are about 25 billion of outflows out of emerging equities. I think we're sitting on around 55 billion year-to-date inflows into EMD. JP Morgan is thinking that goes to maybe 60, 65. We've had like 2 negative outflow years in the last 4 or 5 years. So, if you put this in the context of the size of the asset class or in the context of the size of other asset classes, it's pretty small. And I think that's actually one of the arguments for liking EMFX today is that positioning is largely pretty light, right? Valuations are very attractive. The problem is that we still don't have the most important ingredient, which is growth. If the global economy and EM start to find a base and we see green shoots into 2020, and we can talk about what might bring that, potentially this becomes probably one of the most attractive trades in EMFX. But again, to me, just by looking at flows out of equities emerging in the last 5-6 years, it's very hard to make the argument that emerging EMFX is crowded. The broader picture, we still find, and it still shocks me to come across a lot of institutions, especially here in the US, not so much outside the US, thinking about insurance companies, pension funds, that actually have no exposure to EMD. They continue to prefer to carve out an equity component out of their portfolios to allocate to emerging equities and not do the EMD side. That's beginning to change, but that's a structural structural issue that I think over time, will continue to provide this anchor. And these institutional investor flows are positive pretty much every year, including in 2008, or 2009, right after the global financial crisis. And let me just say, going back to the question on global growth and the risks, I agree. I don't think we're about to fall off a cliff in the global economy. I think that's exaggerated. The consumer is in extremely good shape in the US and in the Eurozone. I think you get to get the consumer to capitulate in the US before you start talking about significant recession risk. Some of these risks are in the price. This uncertainty around trade is a big deal, not because of the numbers, but because of the uncertainty.
Yep.
But that also, after some people don't want to call it a deal, what happened last Friday, this pause, freezing the escalation of tariffs, it's a net positive, right? And if that carries through into the end of next year, post the US elections, that helps. That uncertainty will not be removed. People are not going to start investing, right? CapEx is not going to pick up just because tariffs are not going higher. But at least you remove things going or getting worse. The problem that I see is that for all risk assets, including EMD, the upside is just not that big anymore, right? The math doesn't give you double-digit returns in 2020. We're talking about absolute yields already at pretty low levels across the board. U.S. credit, U.S. high yield, emerging debt. Spreads are attractive, but absolute levels are tight. Same for equities, right? I'm not a specialist on equities, but I don't know, unless you think that earnings are going to be double-digit in 2020 to justify another 20+% year in returns in equities. So it's a little bit of the asymmetry, right? In terms of things go okay,
Yep.
Or they don't get worse, then it's fine. Spreads remain relatively stable. We're not going to have big moves in underlying U.S. rates, or returns are should be positive in that context. But if we miss it and we go into a recession environment, or the perception of recession begins to escalate, we're clearly not priced for that. So I think that's going to be the challenge.
Right.
Thinking about how do you play 2020.
Rob, how do you see that trade-off? Obviously, we've done QE, we've done all kinds of experiments that are unprecedented, right? Are we cruising for a bruising on that front? And then, the asymmetry that Gorky mentions, right? We've inflated lots of risk assets, right? So, how do you see that from a macro perspective?
Well, no matter whether you look at it in debt space or in equity space, the relative trade is there, right? So you have to invest somewhere.
Yep.
And bonds at negative yields, I'm not sure are all that attractive. So this is I don't think it's an absolute yield story, but the relative story is there and very compelling. Whether you look in the equity space, you look in fixed income space, we think it's there. As to whether it's a crowded trade, I think in 2014 it was a crowded trade, but look what's happened since then. And comparing, flows in 18, 17, 19 and 18 versus 17. Don't forget, flows back in 2014 were stronger than flows in 2017. So we've had 5 years here where we had, the Chinese currency disruption. We've had a lot of sort of risk events in the last 5 years that have, I think, really held back flows into EM. So, it's not been something where we've seen a tremendous amount of interest. We're not over. A lot of investors, in our sense, are not overweight EM, which should tell you that if the relative value story is there, and we get a turn in some of these underlying factors, that there's something to play for there. This year is tough or comparing anything to this year is pretty tough because we came in at very discounted levels, but we think there's a good relative value story there.
Right. Brian, the elephant in the room, I guess, is this China-U.S. trade thing, right? And I think Rob, you made the point that policy uncertainty indices are super elevated, right? And I think there's two questions, right? The first one, which is there seems to be, and Gorky alluded to this, there's sort of an emerging consensus that perhaps we now have a truce, right? So we don't get an escalation, we don't get much of a rollback of tariffs either, but we're kind of just in a holding pattern. And perhaps there's a political dimension to that, right? We've got elections coming up next year, blah, blah, blah. So I think the question is a truce enough to lift risk appetite, and would that be good to take the edge off these U.S. growth fears, and then by corollary, also be good for emerging markets. And then the related question is, I mean, what I hear again and again is, yeah, okay, the tweet was positive today, but what about tomorrow, right? And people just discount the stuff now. I mean, I was struck. I was at a big asset manager speaking at an offsite when the tweet came out about Turkey 10 days ago, threatening complete destruction, and Turkish lira only moved 2%, right? Tells you that the market is not putting that much weight on these things. But I think there's a flip side, which is on these China negotiations, you can distrust the truce. So how do you come down on those? Is a truce good enough for risk appetite to rebound for growth? And then how should we read this stuff more generally?
I think if we genuinely got a truce that we knew was a truce and we were confident it was going to last as a truce, then I think that was definitely a positive for risk appetite. But it's not going to pan out that way for all the reasons you've just articulated. This thing is so hard to predict. Within the space of 24 hours, we can go from outright escalation to it all being fixed, and I just think it's going to take an awful lot. And so the way we're approaching this is that we want to see a press release on the USTR website that tells us tariffs are not going up. That's not there yet. We're going to wait until we see that before we change our baseline assumption, which is that the tariffs do go up in December. And this is a personal view, but I just see both sides are quite a long way apart on this at the moment. We seem to have the Chinese have an approach which has toughened up recently. We look at the rhetoric before the meeting last week. It was actually pretty aggressive, and they seem to be expecting tariffs to go down before they do anything. They're not going to buy the $50 billion of soybeans until the tariffs go down. That was where we ended up after the last so-called stage of progress. And yet the US approach seems to be unless you make some big concessions, China, we're going to put tariffs up again. So these seem to be quite different positions that they're going into, and I think there's been a bit of a breakdown of trust. A lot of breakdown of trust between the two sides. So I'm really not very optimistic that this gets sorted out in a way that the market will be very confident that this is a real lasting solution, because it could all just change so quickly.
Just when I was starting to feel upbeat on this panel. Tanya.
Yeah, actually, I wanted to add to that. I think a key, to me at least, a key game changer in these trade truce and these bilateral negotiations we had a few months ago when the Trump administration backtracked on its own negotiated trade agreement with Mexico. And the reason it backtracked on that and threatened to impose higher tariffs was nothing related to trade, but it was related to immigration. Yeah. And the idea is we don't like what's happening with immigration, but it could be we don't like what's happening with something X, you pick it, the environment or whatever it is, that is not explicitly related to the trade negotiations. And the decision was made to threaten with tariffs on something that was separate. And this was not just a tariff, a trade agreement that the administration was repealing from the past and from previous administrations, Obama or whatever. This was his own negotiated agreement. So I think after that, the trust that the administration is going to stick by his word on any new agreement, now you're in a much tougher situation, and I think that's why, at least in my experience during the last few days, whenever I've been in a China meeting, there's huge amount of distrust that this truce is going to stay and going to stick, and the uncertainty I think is going to linger, and it's going to affect investment in China and the rest of emerging markets. And if I have 30 seconds to go back to what we were discussing a minute ago, I just want to clarify the transflow data I was quoting is actually a debt data. It's not equities data. So you're absolutely right. The equities and FX positioning is not crowded at all. Where I would disagree is on the FX valuation side of things. In where I look at, I mean, obviously, deciding what value for FX is controversial. So people have different methods. The way I like to look at it is I like to look at productivity differentials, commodities, terms of trade, and carry effectively, among other things. But I think those are key. And when you take that into account, because growth has been so low and it's projected to continue to go lower in a lot of emerging markets, and commodity prices are kind of turning around, and they may go lower if we still have China slowing down and all this uncertainty. When you take those into account and you calculate valuation, you do not get that. At least I do not get that FX valuations look cheap. To me, they still look expensive.
Yeah, I think that's a big point, Gorky.
No, yeah, no. I guess the flip side of that EMFX is the USD, right? The USD has had a super cycle that started in 2014 that we think it's pretty much run its course. So we don't need the US to actually weaken, the US dollar to weaken for EMFX to perform, as long as it doesn't continue to rise. Quickly on China-US trade, I think the big detail here is that there's a U.S. election coming up in November next year, right? And I think that begins to change the dynamics. Clearly, the U.S. is losing this trade war, right? China is not backing down, and the U.S. I think is beginning to lose ammunition. I mean, by December, if they go on with what's on the tariffs will be Chinese items, imported items to the U.S. will be tariffed at 26%? Yeah, you can say, well, yeah, he can double that, sure. But that's beginning to have an effect on the US economy, right? And that's part of the reaction function that we're beginning to see. I completely agree. The Chinese probably say we cannot trust, our counterparties to have a deal. What I'm saying is that as long as this stays status quo until the end of next year, that's a condition. It's not enough, right, to lift spirits and to have people begin to invest. But without that, you don't have the rebound, right?
Yeah.
So it's a condition, but it's not enough.
Yeah.
But as long as it doesn't deteriorate further, and I don't think it will, because it begins to have impact on the U.S. economy, on the U.S. market, I think Trump has completely, aligned his re-election probability with how the U.S. economy is doing and how the markets are doing.
Right.
So the closer we get to November, I think the appetite to escalate this begins to wane. China clearly has a much longer staying power in this game.
There is one issue though with that, is that the US approach to China, it's not just all about Trump anymore.
Right.
A lot of other constituencies are also on this bandwagon now.
Yeah.
It's got into security issues.
Yeah, it's not trade.
It's gone well beyond trade.
Yep.
As you mentioned, immigration policy suddenly became a driver of trade policy. Can Trump afford to be looking weak with China before an election? I mean, it's now, there's a bit of a consensus here that the US needs to be tough with China across the parties.
Right.
So I'm not so convinced about the election dynamics kind of persuading Trump that he has to somehow capitulate. He's got to be careful about not being accused of being too weak.
I agree with you, Brian. I think people are dug in. I think both sides are dug in. And I actually disagree about the trade war. I think this most recent little temporary agreement was actually kind of very positive for the U.S. We got a bunch of ag. Mr. Trump can say, hey, I got a whole bunch of ag purchases, and on the other side, we didn't really commit to a whole lot. So I think he thinks he's winning.
No, but the bigger discussion, right? I mean, number one, the U.S. the trade deficit has actually gone up. Imports out of U.S. imports from China have actually gone down 25%, right? The other way around is only down 10%. So the numbers in that trade war probably don't look better for the U.S. But think about where we are now, right? A year and a half ago, or May of 2018, or even August 2018, you would have thought by now, right, with 20%, 25%, 30% tariffs on Chinese goods, you would have had a deal already, and it's not happening. That's my point.
Yeah.
That the bigger war so far seems to be China now has the upper hand as opposed to the U.S. 12 months ago.
I don't really see that, but I do see that they're both entrenched. Both sides are.
Can I? We're getting a bunch of questions from the audience, and on country-specific situations and your views. And there's one on a country very dear to my heart, Turkey. It's my favorite, one of my favorite places to go, because the economics is so fascinating, and the people are so friendly and so smart. We've obviously come a long way, right, in terms of what has happened. We have a current account that is arguably in balance now. But obviously, we have a place that is really at the core of many geopolitical flashpoints, right? If I had to summarize sentiment in all the conversations that I've had, and the turning point actually was, Tanya, you kind of put your finger on it, in August when Argentina was happening, and Turkey, to many investors, started looking very good and stable, and growth is coming back. So that to me felt like a bit of a turning point, and people have been moving more constructive, including this week. So on the panel, do we think that Turkey has turned the corner? Our fair value for dollar TRY, for example, is 550. It's been that for a while, so we're a little bit on the cheap side, but single digits, nothing to be excited about, so we're basically fair. Is there a good story to tell? Are you focused on that, or are there big risks? Maybe, Brian, we can start with you and just work our way down.
Yeah, I'm a bit skeptical about this view that, what a fantastic adjustment we've seen in Turkey. When you have domestic demand growing at 20% at the beginning of the year, shrinking at 20% by the end of the year, it's not that surprising that your current account deficit disappears. You could argue they had a sudden stop of capital and the market forced the adjustment on them. I'm not sure that tells us how flexible the Turkish economy is. And the biggest part of their external funding requirement was never the current account deficit anyway. That is still there. I think they've been helped out enormously by this huge shift in global monetary conditions, which has allowed them once again to go back to an extremely unorthodox monetary policy stance. So I don't think they're out of the woods yet. I'm not that convinced that the data flow is that positive. The investment numbers are still really poor. They've used fiscal expansion. They've used quasi-fiscal expansion. They've pressured the state banks to be lending more. So it's not. I don't think it's a fantastic macro policy mix. So I don't think they're out of the woods yet at all.
Tanya, you talked about your fair value model. Give me a number.
Yes, but I think when you talk about these high carry currencies, the Argentinas, and not to the same level, but Turkey in this world is very high carry.
Yep.
And so it's a very different way to trade it, and traded it on fair value is probably not something you can do from a macro hedge fund perspective, but you have to look a lot of flows and positioning. And going back to the flow and positioning data, in fact, from the same Transflow data that I was just mentioning, to be consistent, Turkey's actually not positioned, and it was the one country that is the exception in the trend that we've seen in 2019, that it has moved very different than everybody else, because the flows were so bad in 2018. So the fact that you have a not positioned country with high carry and with a current account that has adjusted, I can see why it can trade better for periods of time. Now, I would agree completely, it's not out of the woods. The imbalances are there. We know the problems. We know the fragilities, and they are not gone. But it doesn't mean that they cannot outperform for months at a time, particularly in a negative rates world with very little positioning. So,
Gorky, what's your verdict?
It's hard to paint a picture of Turkey being a country that's on an improving trend, right? Medium long term. It's clearly been going the other way after having made significant progress in the early 2000s. Especially with the EU accession potential. Erdogan has completely, reversed that. The quality of institutions, governance, rule of law, things like that, we know have deteriorated significantly.
Yeah.
But they do have an ability to land on their feet, the Turks, they do. Part of the reason, we think, is that they don't have a lot of debt. The public sector debt to GDP in Turkey is actually pretty low. So their ability to fund themselves is still fairly significant. I would say, they can come to the markets tomorrow, no problem, right? External domestic, and as you pointed out, Tanya, I think it's one of the major economies that has the lowest non-resident participation in their domestic market, and that went down like to 10% from 20+% 2 years ago. So people completely unwound positions out of Turkey. And it is one of the higher yielding in real terms major markets in EM, with inflation coming down probably faster than anybody expected, right? We were very skeptical, critical of the central bank aggressively cutting rates, but they have been, pretty much vindicated to a large degree.
Yep.
And in external markets, Turkey now trades flat to the Ukraine. Yes, the Ukraine is an improving story. Reforms, IMF, new president, significant power, had one majority in parliament. All those things are correct about the Ukraine, but they still have much elevated level of debt to GDP, unlike Turkey. So that's an interesting for us potential, inflection point, right? You have to start wondering, is Turkey now become too cheap, or is it becoming a little tight?
Yep.
But that as an indication of how far it's come down, right?
Yep.
It used to be investment grade 3 years ago.
Yep. I mean, there are so many. You both referenced positioning, and you both agreed on the positioning. And of course, this year has been a story of where, I was there in March, and people were all over the S400 issue, right? It never ended up being this catalyst that is so negative. Rob, where do you end up from a macro perspective on Turkey and perhaps similar countries?
Well, I don't think I have too much to add on Turkey. I mean, I think I agree with most of what was said here. As we're thinking about how we would position, actually, we're looking for, I think, stories where maybe the fundamentals are a little bit more solid. And given that outlook that I sort of laid out for you, the relative, you could say absolutely the yields in Brazil have come down a lot, or the yields in Russia have come down a lot. But on a relative basis, there's still a trade there in our view, and there's maybe less concern about how. I mean, there's definitely concerns, but maybe less acute concern about how the country's going to evolve.
What about Argentina? So that's another flashpoint. Are we cheap enough here? We obviously have big political events still unresolved. We have the IMF here in town, where it's a little bit unclear exactly where they stand. From what I hear, they're doing as few meetings as possible for understandable reasons. Brian, what's your view?
It's not a country I follow closely. We were talking about this in the session outside. I think part of the problems that they had was when there was the change in regime in Argentina. There was so much optimism. I think they kind of got some of the sequencing of the good reforms the wrong way around, in the sense that they hadn't sorted out the inflation problem, they hadn't sorted out the fiscal problem, and yet they sort of liberalised the capital account quite quickly, and then very rapidly ran into problems when the global scenario changed. So I think now they find themselves in very difficult situation. But so does the IMF as well. So that's going to be a very interesting dynamic to watch. But it's right down the bottom of the rating scale and on negative outlook again. So,
is there a trade, Tanya, one way or the other?
I think it's very dangerous to play. Obviously, if the IMF is going to stand by the country, which I think it's looking likely that they will, that's helpful. But if you run any debt sustainability analysis, even with the IMF help pledge so far, and perhaps even if you add a little more, they still look like they're going to be having a very tough time achieving debt sustainability. Now they may postpone, for a little bit the payments, and that may allow them to crawl back out of the place they're in. But to generate growth and exchange rate stability enough to not threaten their external debt profile, I think is going to be a very uphill battle. So I would be very cautious. Now, of course, it's trading cheap, so I can see why some people are interested in playing with it, but I personally would stay on the sidelines for now.
We have Sergi Lanao and Martin Castellano in the audience, who've done a huge amount of work on Argentina and the potential financing gaps, which they estimate to be around 25 billion per year, and potentially a need for additional IMF resources. So to your point, Gorky, how do you see Argentina?
For a country that has its external bonds trading at sub 50 cents,
Yep.
a lot is priced in, right?
Yep.
I mean, you have to essentially assume there's going to be a very aggressive haircut, extension of maturities, et cetera, which could happen. I'm a little bit more optimistic because this will get resolved. The beginning of the resolution will start a week from tomorrow, more likely than not. Elections in October 27th, will provide a president-elect that will probably come up with a plan that may not be completely detailed for the market's liking, but we don't see that they disengage from the IMF because they don't have a choice, right? They don't have access to the markets. They need to stick with the IMF. There will be a new program, another standby loan, or maybe an EFF. There's potential solutions, right? We have a lot of case studies. Ukraine had a debt to GDP of 100%.
Right.
And they only got about a 20% haircut back in 2015. So there are possible solutions that would not imply a massive haircut. But it's going to be pretty bumpy, right, in the next couple of months because it's still, the new government will take office in December, and there's a possibility that we could go to a second round. I mean, the polls, we completely miss the PASO, the primaries, and we could be wrong again on this weekend's or next weekend's outcome. So there's still going to be a lot of uncertainty. But if I had to think about where's Argentina going to be 12 months from now, these bonds, are they going to be at 30 cents or higher than where they are now in the low 40s? I think it's a buy.
Yeah. Final word, Rob, maybe on the global picture, right? I'm basically trying to figure out, should I be positive or be a bit of a downer tonight? Should I be positive? I think perhaps there's a case.
I think I've made my point. I think we're relatively positive. Having put out that positive view, maybe a couple notes of caution, right? I mean, we have, what I think is very interesting about the EM hard dollar asset class is that we all use these indices that are like just kind of randomly defined in some ways, right? Things are capped, things are,
Yep.
So, let's not, as a macro investor, often where we look to places where there's been tremendous amount of credit growth is places where you got to keep an eye on, right? And if you look across the global economy right now, one place there's been a tremendous amount of credit growth is in U.S. dollar Asian bonds. So if you don't follow that market closely, of course, that market's over $1 trillion now. It's bigger than the U.S. high yield market. Biggest part of that is China, and the growth has just been tremendous. So it's a very small part relative to size, a small part of all of our EM indices. So as we manage our EM portfolios, it doesn't seem that relevant. But I think we need to start looking at these pockets of credit that are out there that we're not looking at in our indices that where there's been tremendous growth, and we should keep an eye on. So that would be one area.
Great. All right. Well, hey, we unfortunately have run out of time, but I'm going to take that as a constructive note with a little dose of caution. So we're ending on a positive note, sort of, and I'd like to thank all of you for taking the time.
Thank you. Thanks, everybody. Thanks.